Hey everybody, Economic Ninja here. I hope you are doing well. We're going to be talking about gold, silver in this recent sell-off in the precious metals markets, but we're also going to be talking about the recent sell-off in the stock market. Guys, the April sell-off is still continuing in stocks, and this is a phenomenon that happens actually quite often. I want to explain. When things get bad, you know they're bad when everything is going down. Everything at the same time. You have bonds going down the same day as commodities like oil going down. You have the stock market going down. And even on those rare occasions when you know it's really bad, the dollar index is going down too. And you go, where is all this money flowing? You would think that money would be flowing from, stocks into the dollar or stocks into gold. And so one would be pushing up, but it seems like everything is selling off at the same time. It's total pandemonium. And today is one of those days where we see just about everything selling off at the same time because of panic. What we came out of on Friday, it sounds funny, I came home to Mrs. Ninja on Thursday, said my stomach is churning, I've got to go short the market. And I didn't even make it in time to really catch the knife, or I'm not catching the knife, but I mean let's say drop the knife. And so it's an interesting time. And I want to talk about an interview that we just did on our other channel, Wall Street Ninja, and it's with Ed Steer. And we were talking about the LME, the London Metals Exchange. And I want to explain something very carefully. The system is falling apart right now as we see it. And that interview, I'm going to link it below in the comment section. Go and take a look at it, because right before what I'm going to go over was announced, Ed Steer was talking about the how fragile the LME is and how the metals inside are selling off. There's, it's pandemonium. And then they came out with this announcement, okay? Now, a couple quick things also. The gold and silver that is selling off today, the headline reads that it's because of rate hike jitters. And I want to assure you that first off, they always look for a narrative or a boogeyman or a blame, right? But let's talk about the last time rates trended up. And that was from October 2015 to December of 2018. The Federal Reserve decided to start raising rates, and it ultimately started to really crash the stock markets, where the Dow Jones took like an initial, I think from October of 18 to December of 18, we lost like 19 or 20% on the Dow Jones because companies just couldn't stick with the higher interest rates. The Fed funds rate had hit around 2.25%, and it was just too much. It broke the back of borrowers. They could not borrow any more money. Companies could not do business as normal. So stocks started to sell off. In that amount of time, to give you an idea of what happened with gold, okay, because today they're saying gold selling off because of rate hike jitters, and that's a complete fallacy, because when rates have been low for a long time and then they start to go up, the gold market starts to react over time because people that buy gold buy it for protection, and they know the stocks market and the economy cannot handle higher rates. When it's used to rates for so long at low rates and then you raise them, it hurts the market. So what happens is, or what happened from October of 15, gold was $1,100, almost even, right? By the time December of 18 rolled around and the market was jittering, gold had trended up from $1,100 to $1,282. So over a 10%, a little over a 10% increase in gold in that amount of time as the stock market actually came down. So you could see not only did you appreciate your dollars in gold, but if you were to price the oil or the Dow in gold, you actually made well over 10% on your money. That was just 10% about in currency, USD amount. But if you price it in the Dow to gold, you actually made even a larger return. So I want people to realize that gold historically has gone up during rate hike cycles because the market gets very nervous of how the Fed can pull that off. All right, and all throughout history, and even back before this event, when the Fed started raising rates in 2000, mid 2003, 2004, around that area, gold also trended up until ultimately the Fed had to stop raising their Fed funds rate in, I want to say it was 2006, maybe the beginning of 2006, and they had to start dropping rates because the market started to free fall. And so again, gold has and silver by default, because it's attached to it as a monetary metal still, does well under these times. Now, during sell-off periods like this where there's panic in the streets, yes, you're going to see these. The problem is right now the market, the physical market is so tight, inventories are so low, the premiums keep shooting up. And that is just a product of supply and demand. That is the exciting part about being invested in this market. And again, guys, I'm not a financial advisor or a financial professional. I'm an investor. And so I see these fluctuations. I've been involved in the precious metals, physical precious metals investing market for well over 12 years now. And so I've seen this numerous times. I've just never seen it this bad and for this long. This prolonged increase in and I say it grinning because this is, we're getting close to the end as things are breaking. This prolonged increase in premiums has been going on for almost 2 years now, and it is absolutely phenomenal. So that's the thing. People call up and they go, hey, I saw silver or gold just dropped a little bit. Can I relock in my price? You go, well, even if you could, which that's not how the industry works, even if you could, what are the premiums going for now, and how long are the shipping delays? Because everybody's diving in right now to buy more physical. So that is really exciting. So guys, again, before we get into this article, check out that interview with Ed Steer, because this has, and that's on Wall Street Ninja, that has everything to do with what I'm talking about right now. And we actually got that interview to you guys before this came out. And this is the title: The London Metal Exchange abandons attempt to crack the gold market. This is out of Bloomberg. I'm going to link it below. It says the exchange will abandon its attempt to break into precious metals trading after just 5 years. The world's biggest exchange for industrial metals partnered with banks, including Goldman Sachs Group and Morgan Stanley, in 2017 to launch the contracts. London is one of the two major centers of precious metals trading, where trillions of dollars in gold, silver, and associated derivatives change hands each year. It's almost entirely over-the-counter business, dominated by top bullion banks like JP Morgan Chase and HSBC Holdings. The LME's project sought to move the trade into an exchange comparable to the COMEX in New York, providing more transparency over pricing. Initially, it was met with some success, but volumes dropped steeply after Societe Generale, one of the LME's original partners, closed most of its commodities trading business in 2019. They were having a little bit of problems back then. The decision will come as little surprise to the market, given the contracts haven't traded since 2020, but it's a painful reminder of other issues facing the LME. All right, let me preface all of this right here, because this is CYA time, where these companies and the exchange is trying to cover their butt because of things that they are, let's say, coming up, their shortfalls coming up right now. There's cracks being made in the system. And what I want you to do is check out that interview with Ed Steer, because it is very eye-opening to the amount of, let's say, physical that's available for delivery for these contracts that is available compared to the amount of contracts that are out there, okay? The system is breaking down, and this is very exciting. This is the exciting time of life. However, most people don't understand it because they see the spot price and then they see the physical price, and they don't know how to, how each one of those functions in this market. Let me think about a better way of saying this. I said a long time ago that I believe there'll be a day when silver hits $50 that you will see it cost $100 for a silver eagle. You will literally pay double the price. Some people thought that was crazy, but let's just go back in history. In 2008, when Lehman collapsed, silver was smashed from a spot price of around $19 to, I believe it was $9.60, if my memory serves me right. But to go and buy a silver eagle at any store, it cost around $10. Online, you could probably pick one up for about 15 to 16. That's if you got a smoking deal. But if you go to any shops, you were paying 100% over the spot price for an eagle. Well, the next time silver hits its $50 all-time high, or around $50, I want people to understand that third time is the charm, and this time will be psychologically different. Just like in the last 2 years where we've seen absolutely massive delays, high premiums, it is now changing the way the investor thinks about precious metals, especially on the backs of, as the LME is getting completely crushed in the nickel market, investors are starting to figure this out. And when they see silver hit its all-time high again, it will be all over the news. This will be absolutely crazy. The question is, will you be involved prior or after that moment? When that moment comes, nobody knows. So don't buy it thinking it's going to happen tomorrow. This is definitely a long man's game, but patience is the key in making money. That is always the key in being a successful investor. So I wanted to do this video to encourage you guys, because There's nothing new under the sun, and I believe that we are coming closer and closer to our Lehman Brothers moment. I believe that we just had our Bear Stearns moment worldwide with the fall of the Evergrande commercial-backed mortgage securities, and now it is trickling through the world right now, and the world is freaking out. So these are good times. These are times to be excited about. Just so you guys know, large investors do not care about $1 or $2. They do not care about 20% swings in the stock market. They care about getting in or getting out way before the masses, and that's how you need to think. That is advice. Think like a wealthy person. Don't think about the day-to-day evolutions in the markets, the dollar here, the dollar there. That's not the key. You're looking at the big cycle, the big trade, okay? Getting in or getting out prior to the masses, okay? You want to be a trendsetter, not a trend follower. All right, guys, that being said, I hope you guys got something out of this. Thank you for all the new subscribers. The Economic Ninja is out.